Hello and welcome to today's webinar. We'll get started in just a minute and let some final people dial in, so sit tight and we'll be right back. Thanks for joining. My name is Cassie Rowe, Content Marketing Specialist here at 451 Research. Today's webinar, Tech M&A Activity and Outlook for Machine Learning, will be presented today by Brenon Daly, Senior Vice President of Financials, and Nick Patience, Founder and Research Vice President. Before we get into the content, I just want to give a brief introduction to 451 Research for those of you who aren't familiar with us. 451 Research is a top-tier research and advisory firm headquartered in New York City. Our team of more than 100 analysts cover more than 2,000 technology vendors and service providers every year. 451 Research provides unique insight into emerging disruptive technologies and the companies bringing them to market, and deliver that insight via syndicated research, advisory services, and live events around the world. Before I turn it over to today's presenters, just a few housekeeping items. The webinar slides can be downloaded in the attachments and links section of the BrightTalk platform. You can submit questions to the presenters in the same platform for the Q&A at the end of this webinar. And the recording will be available immediately after today's session. Without further ado, I'm going to turn it over to Brenon.
All right, well, thank you, Cassie, and thanks to all of you for joining us here on what's a special edition of our Tech M&A webinar. So today we're going to be looking not only at the overall Tech M&A market, but we'll also have a special focus on the fastest growing segment of that market, machine learning. Just to give a sense of how this morning's webinar will flow, think about the webinar in terms of 3 acts. I'll open with an overview of the tech M&A market, and as you're going to see, it's a very busy time right now in the tech M&A market already. The second highest spending since the year 2000. In fact, we're within about 3% of setting a new record, so we're closing in on that top spot. But we're going to look at not only what's driving this year's activity, but also how that's going to carry through into 2019. Because as most of you are certainly aware, we've had quite a few cross currents now and some uncertainty that's sort of settling down some of the activity in the M&A market. So we'll look at that, both year-to-date activity as well as the forecast for 2019. Then from the big picture, we're going to drop down to the most dynamic and fastest growing segment of the overall tech market, and that is machine learning. We're talking about year-on-year growth of about 50% in recent years. So I'm going to look at who's buying, what they're paying, and why they're actually doing those deals. And then for the third and final segment, I'm going to turn it over to my colleague, Nick Patience. Now, Nick heads up our software practice, and he's going to talk about the technology of machine learning. And in particular, he's going to be drawing on some of the survey work that he's done with actual users of the machine learning technology. So one way to think about this morning's webinar is Nick's going to be talking about how ML works, and I'm going to be sort of talking about what it's worth. But before we get to the actual machine learning, I just want to help set the stage with an overview of the tech M&A market. And what we're looking at here is comes from our 451 Research M&A knowledge base. Now, just a quick little advertisement for our M&A knowledge base. It's the industry's only tech-specific M&A database. About 60,000 transactions going back to January 1st, 2002. It's a very powerful M&A tool. You're going to see it in action throughout this morning's webinar. So what you're seeing here is just a cut of, from our M&A knowledge base, just a cut of both the number of transactions as well as the spending attached to them for each of the years going back a decade and a half. So the blue bars coming up off the bottom represent the amount of spending for each of those years. while the orange line sort of bopping across the top there represents the number of transactions. And to be clear, this is tech and telco on a global basis. So it's a comprehensive measure of activity. And I think as you look at the sort of the cycle having played out here, certainly since the middle of last decade, what I'd highlight though, and where I'd spend most of my comments this morning would be around the more recent activity. If you look at the far right-hand side of the slide, you can see very strong performance here, very strong spending, again, represented by those blue bars here in 2018. In fact, closing in on 2015's record spend. We're at about more than $550 billion, so that's $500 billion already here from consideration passed from buyer to seller for tech deals this year. Now, it's probably, I'm going to guess, we're going to come up a little bit light in terms of taking out that new record and setting a new record, 575 back in 2015. But what I'd suggest is probably more important than where the actual dollar value for deals this year settles out is notice the resurgence here in the tech market, particularly after 2 consecutive years of lower spending, both 2016 and 2017, right? 2018, spending about 2/3 higher than we saw in 2017. If I had to single out one reason for that resurgence in the overall spending, again, closing in on a record, it would be the return of the tech bellwethers, right? The main acquirers in the tech M&A markets, these sort of household names, are stepping back into the acquisition market. And here I'm talking about names like Microsoft and Salesforce, IBM, Adobe, SAP. All of those companies have done multi-billion-dollar deals here in 2018. Last year, in contrast, not a single one of them did. So in 2017, they were 0 for 5. This year, they're 5 for 5. So clearly something's changed, right? And when we start looking at and pulling apart how 2017 is different from 2018, you start thinking about the requisite components of M&A, right? You start talking about cash and confidence, right? Those are the 2 things you need to do to complete a transaction. You have to have the desire to buy something and the means with which to pay for it. And what I would suggest, certainly on the cash side, right, tech companies are holding more cash than they've ever held, both because of overall performance, but also those changes in the tax code, which took effect at the start of this year, right, dropping the corporate tax rate from 30% down to 20%, as well as freeing up some of that offshore earnings to be repatriated. So the net effect of those tax changes has been stuffed treasuries. Like, companies really have more cash than they know what to do with. So they've been betting big. Now confidence, right, the other part of the equation, up until probably 2 months ago, right, confidence had been running pretty high. We had strong tech earnings, about 20% earnings growth, Q1 through Q3. And we had very strong equity market performance, right? If you use that as sort of a proxy of how companies are doing, the overall performance of technology, right, with companies, some of these large cap companies having doubled and tripled their market value over the past 2 and 3 years, very strong performance. So we had record levels of cash and confidence, and you saw that help spark some very almost risky transactions, right? It emboldened a lot of the board of directors and executives to go out and do relatively speculative deals, right? You think about Microsoft, a $100 billion proprietary software and services company buying open source company GitHub for $7.5 billion, right? Think about IBM. It's a company that for 20 of the last 25 quarters has shrunk, right? Has reported declining revenue, turns around and does the largest software acquisition in history, right? We're talking about $33 billion for Red Hat. So again, when you think about 2018, think about strong performance due to record levels of cash, but also that confidence. Now, obviously, some of that confidence has eroded due to the recent volatility. And we've seen the equity markets, for example, dip into the red now for year to date here in 2018. So certainly as we look ahead, which is what we're doing on this slide, as we look ahead, there are certainly some cross currents in the tech M&A market. And just to help explain what this slide is, twice a year, we are in market with a survey from Morrison Forrester and 451 Research. It's Tech M&A Leader Survey. Probably some of you on this webinar take your time and give us your thoughts on where the market is and where it's heading. And as always, we appreciate you taking time and sharing that. But basically, we ask our about 150 folks from the tech M&A community, we ask them sort of, what do you see happening over the next half year or so? And I think the key findings on these are the two most recent survey results, and those are on the far right-hand side. So back in April, as you look at it, you can see overwhelmingly, right, 2/3 of the respondents forecasting an uptick in M&A activity, right, second highest result overall. And if you think about how that actually translated, right, it did come through, how that sentiment translated, it did come through in the deal flow. When we go back to our M&A knowledge base and look at Q1, Q2, and Q3, we saw sequential increases in spending, right? It's very unusual to see back-to-back-to-back increases in spending. So there was some wisdom of the crowd there going back to April's survey. Fast forward 6 months, right, and think about October. This is when we started seeing some of that volatility rip through the market, right? We had huge swings. And some of that uncertainty certainly helped shape the responses. You can see, the lowest forecast in terms of an uptick in acquisition activity in 2.5 years. So, on its own, the most recent survey, again, and that covers basically this fall activity through next spring. So if you look at it on its own, it seems like a fairly bearish indicator, right? You see the lowest sentiment in 2.5 years. But what I would suggest is look at it from where we're coming from. Look at April and October together. And what I mean by that is, yes, we're coming down, right? The forecast is deteriorating a little bit there, or somewhat markedly from April to October. However, we're coming down from very high highs, right? Again, keep in mind, when we were in market in October, we were at record levels of spending. So one way to think about it is just to focus on that orange line instead. And that, to be clear, that's the number of respondents who were forecasting a deceleration of M&A activity. And so if you back those responses out, one way to think about the most recent survey results would be that 5 out of 6 respondents forecast an increase or holding steady from the current record rate. So it's actually, with that context, it's actually a fairly bullish indication for activity as we head into 2019. Now, I mentioned earlier that we are running basically at a near record levels of spend, and that's due almost entirely to what you see on this slide. This is the number of billion-dollar transactions going back a decade. And what I've done for each of those years, as you look at the deal count across since 2008, what I've done is segment each of those years by buyer group. The blue portion for each of those annual totals represents those deals done by corporate acquirers. Those are the strategic acquirers that we look to sort of set the tone in the overall market. We're talking about names like IBM and Oracle, Cisco, Microsoft, and so on, right? So that's the blue portion. Topping that as sort of a recent addition is the activity by financial acquirers, so private equity shops like Vista and Thoma Bravo, TPG, and so on. And what you notice if you look back a decade, right, private equity barely figured into the tech landscape, certainly not at that level that we're looking at here. Again, these are billion-dollar plus by equity value, billion-dollar plus transactions. So, a decade ago we were talking about a handful of deals done by private equity firms. But look at more recent years, right? We're talking about fully 1/3 of these big ticket deals being done by private equity. Now, I'm going to look at private equity a little bit more in a couple of slides, but I would just notice, again, put it all together and you've got record number, both buying groups having announced more transactions so far this year than any year in history. And if you put it together, right, you're talking about more than 100 deals, which at a cadence, right, since the start of this year of $2 billion plus transactions announced every week in and week out since January. So this is truly a head-spinning pace. Not everybody, though, is a fan of some of these big ticket transactions. So what we've done here, and this is, I borrowed this slide from some of my colleagues who work on the Voice of the Enterprise. And the Voice of the Enterprise surveys IT professionals. And relevant to us, they asked in their most recent survey, this was just closed, by the way, they asked about 1,000 respondents. And again, these are IT buyers and users. And they asked them, given all of the tech acquisitions and those big deals that we're seeing, how concerned are you that one of your key suppliers is going to get snapped up? And if you look at the top of the slide there, right, there's a significant concern. Right? We're talking about 4 out of 10 respondents saying they have some misgivings about all of this M&A activity. Right? And again, this is an important indicator because, you know, this is the voice of the customer. This is what the suppliers are saying. In some cases, the vote respondents are the actual customers of the target company that have supplied the growth and the revenue and so on that made that acquired company, you know, attractive in the first place. And this is them saying, basically, we've got some skepticism about that pairing. And we followed this up question of, you know, do you have concerns with, okay, what are those concerns? And they're primarily the ones you would expect about product disruption and distraction. So, you know, a smaller company getting absorbed by a larger one and kind of losing its way. And again, keep in mind, these are IT professionals who are counting on products and services as they lay out their long-term IT roadmaps. They want to be able to bank on the delivery of those products. And in some cases, right, you can see a fair number of them have some concerns about that. So again, it doesn't mean that a deal is doomed, right? These sort of billion-dollar plus deals doesn't mean that it's doomed, but it certainly does raise some questions. Nonetheless, right, big deals are going off. And then one of the reasons why, if you think back 2 slides, right, record levels of billion-dollar plus transactions, one of the reasons why we're seeing that record number is because the buyers are paying up for it. Just to help explain this slide, I've gone back 5 years and just run a cut for the 2 buying groups, right, both strategic, which is represented by those blue bars, and the financial acquirers, which are represented by those orange bars for each of those years. And this is just, for each of those groups, this is just the 50 largest transactions and the price to sales ratios of those deals. So when you look at the most recent activity here in 2018, right, look at the blue bar. This is this is corporate acquirers paying 7 times trailing sales on some of the deals. Right? And think back through some of those big announcements that we've seen. Again, this is the 50 largest deals for each of those years. Think about some of the prints this year, whether it was Salesforce paying more than 20 times trailing sales for MuleSoft, Cisco paying a similar kind of valuation for Duo, which was an authentication vendor. CA, when Broadcom picked up CA, that was the highest per share price that they'd hit since the internet bubble. So these are, you know, strong valuations that corporates are paying because, again, strong cash flow, that are strong treasury holdings, as well as up until certainly October, very strong confidence. So you put that together and they're paying up for the targets that they're buying. If you switch to the orange segments for each of those years, again, that is the private equity group. That's the financial acquirers. And notice, too, here in 2018, record valuations being paid by sponsors. 4.5 times trailing sales, more in line, when you think about it, more in line with what strategic acquirers have been paying recently. And one way to think about that, obviously, besides the fact that, you know, again, financial acquirers have more money than they've ever held before, and there's an ever-increasing number of private equity shops, right? So there's a lot of competition for private equity deals. I think if you talk to any of the sponsors out there, they will certainly echo that because deals are very contested. But when you think about the overall valuation and the fact that, you know, again, financials are paying basically what strategics paid in previous years, it's a somewhat unusual phenomenon because strategics year in and year out, at least historically, have been able to enjoy some of those cost synergies. So they've always been able to pay more up front right? So higher valuations because they knew they could get some of those, reduce some of the costs, whether it was back office or even duplicate personnel, those kind of synergies. They could realize those, which effectively increased their return. So they could pay more upfront, knowing that the ongoing costs would be lower. But here with private equity, right, because of the broad portfolio that they own now, right, the fact that they have hundreds of companies now in their portfolio, they're starting to enjoy some of those cost synergies as well. And they're doing deals that are predicated on follow-on acquisitions. So, you know, they're starting to enjoy some of those cost advantages that had typically been only available to the strategic acquirers. So again, a very big shift in the tech market, and you put it all together, and again, record levels of valuation, which goes some way of explaining why we're seeing those record number of deals. Now, I mentioned private equity as an emerging force inside the tech M&A landscape, and it's one that's, quite frankly, is underappreciated by the majority, certainly out here in Silicon Valley. But what I've done here is just basically laid out the relentless rise of private equity. If you go back, so to be clear, the blue line coming up off the bottom there, that steady increasing line every year, that's the deals done by financial acquirers. And that is deals, direct deals, so direct investments, so platform acquisitions, as well as the follow-on acquisitions done by their portfolio companies, right? So this is a comprehensive measure of PE activity. And just to be clear, on the orange line that's running across the top there, those are tech deals done by U.S. publicly traded companies. So NASDAQ, NYSE listed, that's our proxy for strategic acquisitions. But notice what's happened. Last year, the lines crossed. Right? We actually saw more financial acquisitions of tech companies than strategic acquisitions of technology companies, right? 6 years ago, 5 years ago, right, strategic acquirers were putting up twice the number of tech deals that PE were putting up. And notice right now, you know, this year, and I can tell you that, you know, private equity will probably eclipse that number. They're putting up more than 1,000 tech acquisitions, right, which is actually more than the strategic acquirers were putting up in their heyday, right? Look back, compare this year's performance for private equity compared to strategic acquirers, even back, you know, 3 and 4 years ago when they were very active. And notice what's happened to the orange line. Again, this is the strategic acquisitions, right? We're on pace now for a third consecutive decline, again, between the number of tech deals done by publicly traded companies. So there's been a dramatic shift in the market, right? It's almost as if a new market maker has emerged, and that comes through even really more clearly when you look at private equity in isolation. So this is just similar to the opening slide that I had around number of transactions and spending attached to them, but for private equity only. So again, this is all deals, so this is direct investment as well as portfolio acquisitions, tech and telco on a global basis. So it's a comprehensive measure of activity, but notice the trend line, right? Starting with that orange line, which again is deal volume, right? We're talking about having doubled since 2015, right? And already more than 1,000 deals here in 2018. The only way you get to that sort of total is to have these companies, these private equity firms, just basically revving up their deal machines. I mean, Vista Equity is averaging 3 deals every month here in 2018. Thoma Bravo and Marlin are both averaging about 2 deals every month. I mean, that is quick acceleration. That's why, you know, again, they've cracked more than 1,000 transactions here in 2018. And quickly, if you flip to the blue bars, which again is spending by private equity firms, you can see again, record spend to the point where basically 1 out of every $4 in the overall tech M&A market is now coming from financial acquirers, right? And these are big deals. Think about just earlier this week, Travelport, the LBO of Travelport was $4 billion LBO. We had Imperva at $2 billion, Rocket Software at several billion dollars. So these are large transactions helping to drive that spend total to, again, a record level here in 2018. Now, for my final slide in the overall market, I just want to touch on one that's probably a little bit closer to many of you. Don't underestimate, I'd go back just to one slide, don't underestimate the impact that private equity is having in the tech landscape. I mean, they are power brokers right now. But when we think about tech M&A, we tend to think about more around venture capital, right? And what you see here is a changing landscape, sort of a transition in venture-backed exits as well. So just to be clear, this is a tally for each of the years going back to the start of the decade of the number of venture-backed startups that sell each year, as well as the proceeds that are generated by that sale. So this could be a venture-backed company, any stage, could be early, seed money on through, Series A through Series Z, basically. So this is any company that's drawn institutional venture capital that has sold. Now, if you focus on the far right-hand side of the slide, the most recent activity here, you can see, $80 billion of distribution so far this year, record level, looks great, right? But if you look inside, again, if we just focus on the blue bars for each of those years, right, that's spending. If you look inside this year's activity, it's not so encouraging. Basically, what we're looking at is fewer exits, but much larger exits, right? This year, I can tell you in 2018, we've had 2 of the 3 largest sales of venture-backed startups in history, right? That was Flipkart for $16 billion and GitHub for $7.5 billion, right? So again, 2 of the 3 largest prints for venture investors have come this year. And we look elsewhere. I mentioned Duo earlier. That was about $2 billion in change. Glassdoor sold for more than $1 billion. But what's happening for the venture industry is that it's a polarization, right? There are fewer exits, but much bigger, which is also, by the way, what's happening in the funding side of venture community, right? If you think back to Q3, there were 55 announced rounds of more than $100 million, right? There were 6 of them that were north of $500 million, right? So $500 million in a single round that was put to work. This is sort of the SoftBank effect and the impact here on the venture community. But this polarization is not necessarily a very healthy development. And that comes through when you think about the spending, right, the realized proceeds, compared to the orange line, which again is the number of exits. And you can see when you think, we're going to come in at slightly above where we were last year, but still about 100 exits fewer than what we were seeing 4 and 5 years ago. This is a worrying development, right? This is something worth paying attention to because, this is not a healthy sign for the broader ecosystem. When you think about the venture capital ecosystem, right? For any ecosystem, you need liquidity, and it's not flowing to the majority of participants, right? If you think about, just as an exercise in math, think about 100 fewer exits this year compared to, again, 4 and 5 years ago, 100 fewer exits. And if you take average venture exit, just to keep the math easy, we'll take a $100 million exit, right? Multiply 100 fewer exits by $100 million, and you're talking about $10 billion. But $10 billion that is not going back into the venture community, not going back to investors and their limited partners, not going back to entrepreneurs as well as employees. So this is a very important development, and it's certainly one that we're paying attention to out here in California, because longer term, this could have very severe implications for the venture community. But from there, I want to shift very quickly, from this big picture, I want to shift very quickly to the narrowing down to look at the machine learning. And I'm going to be focused on the M&A, the acquisition activity. In a few slides, I'm going to turn over the presentation to Nick, who's going to focus more on the implementation. But, I think both of us would agree, and certainly it will come through in Nick's presentation, as you'll see in mine as well, is ML is very much an emerging technology, right? This is still a nascent, very much, early days for this technology. And when you think about it in the context of M&A, you're talking about 140, 150 ML deals this year here in calendar 2018. That's on a base of about 3,800 overall tech transactions. So, you're talking about a very tiny sliver, sort of 3 and 4% of overall deal flow being machine learning deals. So it is early days, right? It's a very small portion of the market right now, but as you're going to see, it is a very important portion of the market. And, the thing to keep in mind, though, is, again, as any technology in the emerging days and the early days, right, the deals are much more valued on potential business rather than actual business. So if that's the case, right, if it is still very much an emerging technology, why are we bothering to talk about it? Well, this slide is basically tells us, we're talking about it because you all are working on it. So this is a slide that we do. This comes from a tech investment banking survey that we do each year. We've done it for the last 14 years, and in fact, we're in market right now with this year's edition of the Senior Investment Bankers Survey. So if it's in your inbox, we'd appreciate you sharing your thoughts, giving us 5 minutes of your time to share some thoughts with where the market is, where it's heading. But basically, on this slide, what we were asking is, looking inside your pipeline, right? What do you expect to be busy with for the coming year? You can see topping the list was machine learning, right? More than 9 out of 10 investment bankers were saying they expect to be working on ML deals, right? Highest level overall. For the first time ever, not a single investment banker said they are going to be working on fewer ML deals. And importantly, I would say that this is, again, based on actual discussions, based on actual conversations, and in some cases, engagements, right? This is in bankers looking in their pipeline, not just, an empty question about, hey, what's going to be hot in 2018. This is them actually saying, hey, this is what I'm working on. So a very strong endorsement for deal flow in machine learning. Let's see how that comes through, that sentiment comes through in the actual deal flow. So this is going back to our 451 Research M&A knowledge base. It's searchable by about 650 different criteria, including machine learning, which is what you're seeing on this slide. So this is just a capture for, going back to the start of the decade. You can see a handful of transactions for machine learning, but notice what's happened more recently, right? A dramatic acceleration. We're talking about 2018, that 140 deals could be actually a little bit conservative, but we'll see. We've got 3 weeks of the year left. We'll see where it actually settles out. But you're talking about certainly doubling from 2 years ago, more than tripling the 2015 count. So when you see that kind of growth, you prompts the obvious question of, well, who's behind it? Who's responsible for driving that sort of growth in the ML deals? Right? And keep in mind, too, that this activity is coming on the broader context of basically flat to down overall tech M&A activity, as well as flat to down activity in the overall enterprise software market, right? So we're seeing the broader market actually sort of flatline. Here we're seeing dramatic growth. So, behind this is basically the key players, those technology companies that you would expect to be active in ML are active. And that's in large part because they are the ones with the data. As Nick's going to talk about, right, the companies that sit on the data have an inherent need to make sense of it. And so you're seeing the large companies, large tech vendors like Microsoft and Google, like IBM and Salesforce and Intel. Those 5 companies, by the way, are the top 5 acquirers in order for machine learning transactions by our tally. So, again, in order, that was Microsoft, Google, IBM, Salesforce, and Intel. So, a representation of the companies you would expect. However, all different drivers, right? Different strategy that's playing out in this emerging market. Microsoft early days was very much focused on securing Azure, right? So they did a number of machine learning security deals, whereas Google, in contrast, right, has done sort of one landmark transaction. That was 2014's purchase of DeepMind, right? And then grown that substantially more. So again, different, very similar companies, buying groups for the most part, but a very different sort of orientation of what they're looking for when they do those deals. Now, to help make sense of that growth and those overall market, what I've done is basically borrowed some sectors and some rationales from Nick. And again, this was one of he used this question to sort of tease out what people were actually using ML for. And I flipped it around and said, okay, let's apply some intelligence to a data set. Let's try and make sense of the deal flow for ML. And what we've done is sort of bucketed all of those transactions that you saw in the previous slide into what people are actually doing with ML. And so you can see topping the list there, business analytics, right? And this is, just to be clear, this is sort of, making sense of those broad horizontal software planks, all the information that comes out of ERP systems and HCM systems and even supply chain management. So it's very much analyzing and optimizing with an eye towards forecasting, right? Because a lot of business operations is about resource allocation. And so this is basically making your business smarter. Importantly, it is primarily internally focused. Right? It is inside the four walls of the business. In contrast, notice the second highest ranked in terms of acquisition driver. That's sales and marketing. That is externally focused. Right? That is making commerce smarter. So what we're seeing there is machine learning models for improving open rates around outbound email marketing initiatives. Or if you're in sales, there's lead scoring, right, which is basically probability, right, of what's the likelihood of a certain outcome, which machine learning does very well. And so you've seen some of the buyers like Salesforce and Exactly and Adobe do ML deals around sales and marketing. And then third, when we look at the third most common reason for ML deals is security. And again, if I were to, one observation on that is just early days, right? If we think back to sort of the start of the decade, a lot of the information security transactions around machine learning were done for the network security, right? Where we had vast flows of information over the network. But increasingly what we're seeing in sort of in the last 2 and 3 years is the focus has shifted from the network to the endpoint. Right? And we've seen this proliferation of endpoints, and certainly, think about your own cell phone, right? The amount of data that's kicked up by all of those endpoints is sort of ever increasing. And importantly, on endpoints, right? When you're securing an endpoint, the time to fix is the crucial determinant, right? How long is that vulnerability open, basically? And machines move much faster than people. So that's one of the more recent drivers for information security. But you break it down, you have these 3 main reasons why companies are going out and going through the time and trouble to buy ML. Now, for my final slide, before I hand it over to Nick, this is actually a slide I borrowed from Nick. And what he did was take those same drivers, but flip it around and ask the actual ML users, why are you using ML? What are you looking for? And so you can see the same subjects, right, the same themes emerging. And notice starting at the top, the business analytics, right? As with acquisition drivers, it was the number one, the top, and roughly, a 1-to-1 correlation when you look at implementation versus acquisition. So very tight correlation, but notice what happened underneath there, right? Security and sales and marketing flip-flopped. A quarter here, as you can see on the implementations, a quarter of them are around information security, which is underrepresented. If we flip back a slide, it's underrepresented relative to its portion of deal flow. While sales and marketing, is overrepresented in terms of, when we compare the initiatives around implementation to the drivers for acquisition. So there's a little bit, I guess what I'm trying to say as I hand off this to Nick is there's a little bit right now of imbalance between the supply, right, how companies are buying and positioning ML offerings, and what users are actually doing with this emerging technology. So anyway, Nick's gonna pick up the webinar from here, and he'll have more about the implementation. So Nick, I'll turn it over to you.
Great, thank you, Brenon, and thanks everybody for their time this morning. So, yeah, as Brenon said, I'm just going to look a little bit less at the M&A angle and more at the adoption and use cases of machine learning here. So, I think in any period of exponential growth is worth asking yourselves, when will this change into an S-curve? Why? Because ultimately, most trends are S-curves. Things, at first, things happen slowly, often change, or technology adoption, in our case, may be imperceptible at this very early stage, but then things start to change quickly, and then very quickly, and then it slows down until it becomes almost constant. An S-curve, as we know, can describe how ice melts, how water evaporates, the expansion of the early universe, the fall of empires, and yes, the spread of new technologies. Here we can layer on Everett Rogers' adoption scenarios. And that fairly pale blue line is my non-scientific estimate of where we are. Maybe we're even slightly to the left of that. It's very, very early days. And that's kind of reflected in what we see, but I just wanted to explain some of these numbers. So we asked people here what stage they're at in terms of adoption of machine learning, and 17% said we currently deploy it, and 19% said, well, we're actually in the development stage of it, and 12% said, we're not doing it yet, but we plan to in the next 12 months. Now, that might sound like that's actually a lot further along than my estimation on the S-curve, but my explanation of this, and through my observation of what's going on in the enterprises out there, is that an adoption of machine learning could be one very narrow sliver in their overall technology portfolio. So Brenon was talking about security a lot recently. You could say they might have just bought a security product that has some sort of unsupervised machine learning element in it to detect anomalies on a network. That's machine learning adoption. So what I'm not seeing at the moment are enterprises transforming their entire organization using AI and machine learning. That is not happening yet. It probably will happen one day. But what's actually happening is people are buying sliver after sliver after sliver after sliver of machine learning, either tools to build the stuff themselves, or they're buying the applications with this stuff already built in. So another way of looking at this is that same data is to think about it as a growth path. So we saw 17% are already deploying it. That's roughly 1 in 6. If we add that to those folks that are not deploying yet but are developing, another 19%, and 12% plan to use within a year. If we think about that, and we came back this time next year, that's about 48%, which is roughly 3 times the current state of the 17% that have deployed it now. And I expect we'll see something like that. And again, that doesn't mean that everybody's using it for absolutely every application or even half of their applications. It means that somewhere there's machine learning activity going on, and that will lead to greater transformation down the road. And this is a bit of an eye chart, but you've got the downloads here. People on you can download the deck on the right-hand side. Just look at a few of the verticals here. So in financial services, no surprise that they're the furthest along in terms of deployment. But media and publishing, obviously, an industry that is rich in unstructured data, which is the main data type that you get from which you get the most value using machine learning. So uncovering patterns in vast quantities of unstructured data is one of its main attributes. Is another one. Telecommunications, an area that's been using machine learning for churn analysis, for fraud detection, and things like that for many years. So let's just look again at this slide. So this is the same data of one of the 2 slides that Brenon showed, where we essentially grouped together use cases. So business analytics hides a lot of complexity underneath that. There's a lot of stuff in there around forecasting, but essentially the desire to analyze data for business reasons is the top overall driver. That's, again, not a surprise because that is its main attribute. Pulling together large quantities of disparate data sets, and the disparate element is at the moment the most important thing, not so much the speed. I think the need for real-time analysis will come as we move machine learning inferencing further to the edge. But at the moment it's that different types of data coming together and spotting patterns within it. So within that group of business analytics, this data, I should say, comes from our Voice of the Enterprise AI and Machine Learning survey, the first survey report of which came out in the summer, and the next one is coming out next month. I have the data now, we're just going through the analysis period. But that business analytics group hides things like forecasting, workforce utilization and optimization, and preventive maintenance, things like that. So security there, second. which, to be honest, is an area that also takes advantage of analytics, is often at the cutting edge of technology adoption, and this is also the case here. There are numerous cases of use cases for machine learning security, including unsupervised machine learning. And in sales and marketing use cases, you could also say, are also reliant on analytics. There's a mix of the analytics use cases here. The quarter respondents with those as primary use cases that thus are also supplements in a way to the broader analytics group. And so this is one of the heat maps we have from our what we call our advisor report in our Voice of the Enterprise AI Machine Learning, and our clients get this and many other charts to look at. And what I'd say here is to focus on the dark blue cells on the diagonal from the top left. So you take the one at the very top left, where we ask them, what is the across the top, what is your primary use case today? And then at the side we ask them, what is it you're going to do in the future? And so for those that the primary use case is business analytics, 67% of them say it will also be business analytics in the future. And those not using machine learning for analytics yet tend to view it as the next priority. So if you look at something, you look at it in security, as 69% of the people there, the next highest use case is business analytics with 15%, and we see the same thing with sales and marketing and customer service. I'd say something about customer service is often the first place we find a lot of organizations look. They look at things like classifications of ticketing systems, things like that. So not so much the answering of the question for customer support, but literally just, is this a level 1, is this a level 2, is this a level 3? Machine learning is incredibly good at classification tasks like that. And frankly, that's not a particularly rich career for somebody. That's often better done using software. But in terms of this chart, customer service is often a low-hanging fruit. So once the key elements of that have been automated using ML, organizations are often keen to move on to other use cases, such as business analytics and the others here. Security, the highest number there. I think security does require a singular focus, and although the overall breakdown of each use case remains somewhat consistent in the future, there is some movement between the groups. So we also asked our enterprise audience, and the audience here is made up of our 451 alliance of 50,000 IT line of business decision makers from around the world. We asked them, what is the most significant benefit your organization has realized or expects to realize from its use of machine learning? And look at the top there. The top one is gaining competitive advantage. And I put the headline on here, positive benefits. So the top one is gaining competitive advantage, which I think we agree is a positive thing. The second one is improving customer experience, something most organizations are focused on a daily basis, or should be. And then responding faster to opportunities and threats. So these are, largely speaking, obviously the threat element there is slightly on the dark side, but these are more positive things. What they are not saying is the main use case or the main benefit they expect to get is cost cutting. See, it's down there at 25%. It's obviously a decent number, but we find that's not where people are focused most of their efforts using machine learning. There are so many other things that can be done. Sure, and it depends on in certain industries there will be swathes of cost cutting, but there's so much more that can be done, and I think most people here we find are more focused on those positive benefits than simply slashing headcount and things like that. So we asked them, if you're not doing this, what is the biggest barrier? Or even if you are trying to do this, what is the biggest barrier? And lo and behold, perhaps not surprisingly, lack of skilled resources is way out in front here, with 36% of respondents citing that as the most significant barrier. And then second, with accessing and preparing data. Now, those two things are linked. Why? Well, because the lack of skilled resources, the lack of data science skills. And I'm sure a lot of you heard that being cited around machine learning. So if you kind of look at that as lack of data science skills of 36%, and the second one, accessing and preparing data, which is what data scientists spend probably way too much of their time doing, then you've got clearly where the biggest pain point is. And we see vendors such as Google and Amazon and Microsoft trying to address this by automating parts of the machine learning process, automating the model, the algorithm selection and the hyperparameter tuning and things like that to ameliorate this. Just one quick note on this one also. Look at that one of 2%. Lack of support or involvement for senior leadership is cited by only 2% of people as the biggest barrier. So it's not lack of C-level support. That is not the issue here. They're getting plenty of that. And a lucky 10% down the bottom there have no barriers whatsoever to using machine learning. wish we would all be like that. This is a slide looking at the development of machine learning and where people are doing it. So we're asking people here, what are the tools you're using principally, and where are they located, more to the point, for your development. And then we split these people into three groups. So the people in the dark blue are those that are already deploying. Remember at the beginning we asked deployment versus developing. The orange are developing, and the lighter are the ones that are planning to. And so we see, public cloud is the most favored development environment amongst both those people that are already deploying it and those that are developing it. But the interesting one, somewhat there, I think, like the on-premises private cloud for those already deploying in dark blue, and the on-premises not cloud at all, are both significantly higher. This speaks to our belief that this is going to be a hybrid world, and there's going to be plenty of machine learning that needs to be deployed on-prem. And a lot of the vendors, such as especially Google Cloud Platform and Amazon Web Services and Microsoft, are reacting to that with solutions that enable you to deploy this on-prem. This is an interesting kind of mashup of two surveys. So these are both Voice of the Enterprise surveys. The light blue one is essentially one of our cloud and hosting surveys, which is asking people, which infrastructure as a service provider amongst the large cloud platforms are you using? And then in the dark green is my Voice of the Enterprise AI and Machine Learning survey, where we ask them, yes, but of all the hyperscale cloud vendors, which ones are you using for machine learning? Now, in the light blue, we see the same story we see over and over again. AWS and Microsoft are way ahead of anybody else here in adoption of platform-based, the platform elements of cloud computing. But when we ask them about machine learning, they're almost head-to-head. Now, hence why I put Google and IBM punching above their weight, which may sound a bit silly considering how large those organizations are. But take Google, for example. Google has made many attempts to penetrate the enterprise market. They did it with security back in the day. They tried it with security. They tried it with G Suite, which is going well, but it's up against an enormous competitor. They think, and I agree with them, that machine learning is the foot in the door for Google and Google Cloud Platform specifically. And obviously of note recently is the upcoming moving upstairs, essentially, of Diane Green to be replaced by Thomas Kurian, a veteran, a 22-year veteran of Oracle, to take them further along. And IBM obviously had first mover advantage with Watson. The Watson brand isn't what it was, probably due to mainly to overexposure and dilution. But it's certainly it's certainly very, very important to IBM, especially as you saw last week. It was last week when they sold $1.8 billion of very much legacy software assets to HCL, a company it had a partnership with for a year up until then. But none of that was machine learning, and it's very much focusing on cloud and machine learning to drive itself forward in the future. So that's what we have at the moment, and I think we're happy to take questions. But one of the things I was just thinking about in terms of looking to the future, what we expect to see a little bit in 2019. And some of the deals, and Brenon was saying the volume of deals, and I think we're going to still see a lot of fairly small deals. You think about various things that are elements of the machine learning landscape. So a lot of the algorithms are open source, so they don't need to, with some exceptions, to be acquiring algorithms or such. But they certainly do need to be acquiring skills and doing acqui-hires. The data, which is absolutely the feedstock of machine learning, data is mostly self-generated by organizations. Elsewhere in the Voice of the Enterprise survey, a slide that I don't have here, we ask people, what is your main data source using for machine learning? And not surprisingly, it's internal customer data is by far number one. But that data is mostly self-generated by the organization. Think about your own organization if you work for a bank. And usually not bought in, although there are obviously lots of third-party data providers like Axiom and Oracle Data Cloud and things like that, which are, people do buy in elements of data to supplement they already have. So that's the other point. And then very much the vendors are still assembling the building blocks in terms of acquiring talent and algorithms. There's lots of small acquisitions Google goes on after, obviously, the DeepMind was 4 years ago now. and you're seeing lots of more smaller slot-in acquisitions to try and get talent, and often in specific areas. So if you think of something, a specific area like facial recognition, which there's lots of startups around doing that, I expect to see lots more of those kind of those smaller deals. But all of those ingredients together, so the algorithms being open source, the data mostly being self-generated, and the vendors very much assembling the building blocks, have the ingredients for an M&A market that may not reflect the mania in the overall technology market or outside M&A that AI and ML is causing. But I still think it's M&A is going to be an absolutely crucial element of this going forward.
Well, and that segues nicely to one question that we do have, Nick, and I'll toss it right back to you. Again, there's a question tab on the Bright Talk presentation screen there. So if you do have something that for Nick and I, we do have a few minutes left, about 5 minutes left to tackle some of these questions. We have about half a dozen of them already, but the first one I want to throw to Nick was very much along the lines of what he was just talking about. And the question is do you have thoughts on how machine learning startups are competing with open source tools and the large cloud providers? Can we draw any conclusions about this from the exit environment? So Nick, do you want to start on sort of the technology question, and I'll take a crack at the exit environment? Yeah,
so it's obviously it could be seen as being hard when 2 or 3 years ago, Google and AWS and I would think back to the way Watson was evolved. It was just they chucked up some APIs. So here's our text analytics API, here's our translation API. They weren't necessarily building tools around that. There's a lot of other companies around like DataRobot, H2O, and companies like that are competing head-to-head with those 3 large cloud providers by doing things like having better automated machine learning, or better is a loaded term, but pretty much at least par with them, automated machine learning tools to do things what H2O calls driverless AI, and similar things from other organizations. But so it's very much the algorithms are there. The algorithms are not where the value is. The value is where is the data you're using, and then the the skills and the tools of the developers.
And then if we think about it in terms of the exit environment, so sort of, thinking about it from my world, there was a second question that is very much in line with that, and that was around, do you have any data around the transaction multiples, and in particular enterprise value to revenue for these deals, or trends on valuation for M&A and ML? And, if only it were that simple, right? And as Nick has mentioned, this is very much still an engineer-driven. In most cases, the acquisitions are engineer-driven, right? This is, in some cases algorithms, in some cases tools, but it's primarily, smart people. And accordingly, right, rather than sort of the conventional multiples that we see, like a price-to-sales one, which was the, the basis of the question, it's probably more in line to think about it around like price per head, like a price, like a, take like $2 million, and at least $1 million, maybe two, in some cases north of that, per engineer. And that's the kind of valuations that we're seeing, because again, these tend to be very small shops, right? This is, if you think about a company like Zscaler did its first ever acquisition just recently here, after it went public, it picked up, for example, a 5-person machine learning startup, right? It wasn't because the revenue generated by this startup, right? In fact, it had very much just gotten going, but it was the fact they had smart people that then could help surface some actionable, in this case, pattern matching and sort of anomalous behavior across the data that was already, flowing over Zscaler's products. So in that regard, it's very much a bolt-on, and it's very much engineering focused. So, there isn't a handy sort of, conventional prevailing multiple, and nor will there be. And this is, again, when you think about the acquirers in the market right now, right? Microsoft, which paid a very handsome price for Semantic Machine, right? That was a company, a little startup out here from both Berkeley and Stanford, a lot of smart computer scientists. They paid a substantial price for that. But again, it wasn't because of the revenue generation. It was the fact that, hey, it could fit in with Cortana and some of the other offerings as voice becomes much more of an interface. So, unfortunately, there isn't like, in IT services, it's going to be about plus or minus, 2 times trailing sales. There isn't that sort of handy valuation multiples for ML. So a final question there, Nick. Do you notice any differences in ML acquisitions to improve a company's own business processes? So, again, that sort of business analytics that led the list, versus acquisitions to improve a product offering. So sort of think of internal versus external. Do you see, again, adoption rates, are they influencing valuations, what you've come across?
If we mean by the internal use of a tech vendor, it's more the latter. I think the improve a product offering more than the former. I would say definitely.
Okay, so it's more focused internally, which is what your survey certainly bore out. And there's, by the way, and a final thought on that from, since we're talking about valuations, I mean, there is definite value in that, right? If you think about improving whether it's productivity or profitability from a corporate perspective, right? That's key strategic initiative. And so, it may not, dramatically move the needle, but a couple basis points on an operating margin can result in, a substantial overall, enhancement of your evaluation. So, there's compelling reasons of why companies are doing, even though it's internally focused. So final point, we do have a couple of other questions. I'm afraid we've hit the top of the hour, so we'll get back to those people individually. Two quick notes. Some of you have commented that the slides rendering were a little bit off, so we'll remedy that and get you out a clean copy once you're to be able to see all the work. And some of you have also asked about the M&A knowledge base. Our product manager for that, for the M&A knowledge base will be getting in touch with you. You'll have a chance to demo it, kick the tires, bang on it yourself to see if it's a useful tool for you. So we will be getting back in touch with you also with some of these unanswered questions. Thank you for all of your insightful questions. And most importantly, thank you all for attending here. So we wish you all a good day, and we'll be in touch next time on the next M&A webinar. So thanks, everyone.
Thank you. Have a good day.